Hey, what's happening, traders? Welcome back to No FOMO. Now, I see a lot of my fellow traders out there making the switch over to futures from Forex, which is what I did myself about a year and a half ago. Let me tell you, you get access to so much more data that supports your study. So today, we're diving into a hot topic that confuses a lot of new traders: futures versus Forex. If you've been wondering which market is right for you, stick around because I'm breaking down 10 key differences between these two massive markets. And by the end of this video, you'll have a better understanding of which suits your trading style and your goals. First up, let's talk about market hours. On the future side, these typically trade during specific hours tied to the exchange. So, for example, if you're trading US stock, index futures, they'll follow US market hours. But many contracts like indices can trade nearly 24 hours a day with extended hours. On the other hand, on the Forex side, it's a 24-hour party, 5 days a week, because Forex operates globally across multiple time zones, from Asia to Europe to US. There's always currency market open somewhere. With me, myself, I trade GBP USD and gold on the futures contracts. So they move on Forex hours for the most part. I guess you could say I'm getting the best of both worlds, eh? Next is the underlying assets. On the future side, these are contracts based on things like commodities, oil, gold, stock indices, or even interest rates. You're trading the future price of an asset. On the Forex side, here it's all about currencies. You're trading pairs like the euro against the dollar, the pound against JPY or the Japanese yen, etc., and profiting from value on one currency relative to another. Now, let's get into contract size. On the future side, every futures contract is standardized. For example, if you're trading crude oil, you'll know one contract is worth 1,000 barrels. On the Forex side, Forex gives you flexibility. There's no fixed size, so you can trade micro, mini, or standard lots depending on your risk tolerance. Now, here's where things get spicy. Leverage. On the future side, typically it offers leverage like 10 to 1 or 20 to 1, depending on the asset. It's more conservative because of the volatility of the underlying asset. Now, on the Forex side, Forex is known for crazy leverage, sometimes as high as 50 to 1 or even 100 to 1. This lets you control a large portion with less capital, but of course, it comes with higher risk. Now, let's take some time to talk about who's actually trading. On the future side, the futures market includes lots of commercial players like corporations, farmers who use future contracts to hedge against price fluctuations, in addition to speculators. On the Forex side, while central banks and institutions dominate Forex, there's a massive retail trading community. People like you and me form a significant portion of the Forex traders. Next up is liquidity. Futures liquidity varies based on the contract. Major stock indices are super liquid, while some commodities may not be as active. Now, on the Forex side, Forex takes the crown here, especially for the major currency pairs like euro against the dollar, which have huge liquidity at almost any time of day. Another key difference is how these markets are structured. On the Forex side, it's traded on centralized exchanges like CME or ICE, meaning prices are transparent and you don't have to worry about your broker marking up the prices. On the Forex side, Forex is decentralized, meaning trades go through brokers or market makers and prices can slightly vary depending on the platform that you use. Now, this is important. Expiration dates. On the future side, Every contract has an expiration date. Monthly, quarterly, you name it. You either need to close your position or roll to the next contract. On the Forex side, there is no expiration. You can hold your position as long as your margin requirements allow, giving you more flexibility. Now, let's get into fees and commissions. On the future side, typically charges commissions per contract traded, and sometimes there's additional exchange fees. But on the Forex side, many Forex brokers offer commission-free trading, but they make their money through the bid-ask spread. So you pay indirectly, but it may not always be obvious. Finally, let's talk about regulation. On the future side, heavily regulated. It's heavily regulated by the government bodies like the CFTC in the US, so it's a well-controlled environment. While on the Forex side, the regulation is all over the place. In the US, it's pretty strict with oversight from the NFA and the CFTC, but globally it varies. Some countries have lighter regulations, so you need to make sure your broker is trustworthy. And there you have it. 10 key differences between trading futures and Forex. If you're trying to decide which market to dive into, consider these factors and find what suits your trading style. Don't forget to smash that like button and hit subscribe so you don't miss the future content. And let me know in the comments, are you team futures or team Forex? Until next time, keep on learning, keep trading, and most importantly, no FOMO.